cash market. The cash market is also known as the spot market. Imagine you want to buy a car and you want to buy the car today. What will you simply do? You would go to the market and you would request for the price of the car. Let's also imagine that you were told that the price is worth 10,000 US dollars. Once you pay these 10,000 US dollars today, then the seller would give you the car. The purchase of this car happened in the spot market. The fixed income market, the equity market, currencies market, commodity market, all of these markets are known as the cash market. In this so-called cash market, specific assets are exchanged at the current prices. Current prices are also known as spot prices. It is also possible that you want to buy a car, but you do not intend to buy the car today. You intend to buy the car in future, let's say in 3 months time from now. If you agree on the price today, let's say you agreed on the price at 8,000 US dollars to purchase the car in 3 months time from now. In 3 months time from now, whether the price of the asset of the car has gone up to 11,000 US dollars or it is down to 7,000 US dollars, you will still end up buying the car for the agreed price. What just happened here is in the derivative market. When it comes to the derivative market, the purchase does not happen today. The purchase will happen in future, but the terms are agreed upon today. When the price is agreed upon today, but the exchange of specific assets occur in future, we would say that this transaction takes place in the derivative market. What is a derivative? A derivative is a financial instrument that derives its value, that derives its performance from the performance or from the value of an underlying. Examples of an underlying include assets. It could be physical assets, it could be intangible assets, interest rates, and so on and so forth. A derivative is a financial instrument that derives its value from the performance of an underlying. The derivative market is characterized by the following. The first is there must be a legal contract between the buyer of a derivative contract and the seller of a derivative contract. There must be an agreement. Moving on to the second characteristic of a derivative, there must be an underlying. An underlying is what determines the performance of the derivative. Just like we said on the previous slide, what determines the performance of the derivative we described on the previous slide is the performance of the car. So if the value of the car goes up or comes down, one party will be happy and the other party will be sad. The underlying asset could be an individual asset, it could be a group of standardized assets, it could be variable such as interest rates, credit indices, and so on and so forth. And when it comes to a derivative market, there must always be two parties. One party is called the long. The long is the buyer in a derivative contract, and the short is the seller. So you can easily remember with SS, in case you are new to finance, and we have LB.